internal rate of return. The discount rate that equates the sum of the present values of all cash inflows to the sum of the present values of all cash outflows. In other terms, the discount rate that sets the net present value equal to 0. So, the net present values of positive and negative cash flows of the project will be 0 at IRR. IRR is always a rate in measure, whereas the net present value measures the value or increase in the wealth of the firm. If the IRR exceeds the firm's cost of capital, we can accept the project. If we compare two prospective projects, the project which is having higher IRR will be ranked first and chosen. IRR can also be used to decide whether a single project is worth investing or not. As an instrument of decision making tool, we cannot use the IRR to rate mutually exclusive project. So we should be very careful. If you are having mutually exclusive projects, we cannot use the IRR as a decision making tool. In another case, if the cash flows of the project is in a non-conventional way, here also we cannot use IRR as the decision making tool. What is non-conventional cash flows? See, normally in a conventional cash flow, the initial period will be having negative cash flow. After that, there will be a positive cash flows. In the non-conventional cash flows, initially there will be a negative. After that, there will be some positive cash flows. After that, there may be some negative cash flows. So like that, in a non-conventional way, the cash flows will be in the project. So here also we cannot use IRR as the decision making tool. And IRR cannot be used to measure the projects of different duration. If the project life is different, there also we cannot use IRR as the decision making tool. We have to apply modified IRR to select the projects. This modified IRR considers the cost of capital of the firm. The same way for NPV also, modified net present value we have to find to make the decisions. To calculate IRR, we are not having any specific formula. We have to use trial and error method by taking fake annuity. I am going to explain a 6 steps method to identify the IRR. By using the 6 steps, you can easily identify the IRR. Previously we have seen the smart Xerox and the scan problem. The same problem we will see here for IRR calculation. Please recollect the problem. So we are having exclusive development expenses 1 lakh, and for project 2 we are having exclusive development expenses 165, and we are having some cash inflows for 6 years, that is after tax cash inflows they have given, and initial cost of 10 machines into 2,50,000 for computer devices. The taxation is 33%. All devices are installed at the year 0. The rate of capitalization of the company is 16%. There is no salvage value for the computer device at the end of the project. Okay. Now we will see how to identify IRR using 6 steps method. See, this table we have used for net present value. To identify IRR, we have to first find out the average cash inflow. Average cash inflow. Average cash inflows. So for both projects I have identified average cash inflows. So from 82,500 onwards I have total up to this, up to 1,50,000 I have taken, divided by 6 years. So we are getting see the formula. So I have selected 82,500, 45,000, 55,000, 88,000, 99,000, 1,10,000, 1,50,000 divided by 6. Then we are having average cash inflows for both projects. Now we will